In March of 2023, Silicon Valley Bank collapsed almost overnight. Billions of dollars were suddenly at risk. Customers rushed to withdraw their money. Regulators were forced to intervene. But this was not simply the story of one badly managed bank. It was a warning from a financial system built during more than a decade of almost free money. For years, central banks encouraged borrowing, pushed investors toward greater risk, and repeatedly rescued markets whenever they began to fall. It created enormous wealth. It also created debt, speculation, inequality, and a dangerous belief. The belief that the Federal Reserve would always come to the rescue. So, how did an emergency policy designed to save the economy become the foundation of the entire financial system? And what happens when the era of easy money finally ends? To understand that, we need to return to the moment when the system almost collapsed. In 2008, the global financial system was approaching disaster. Major banks were failing. Credit markets had frozen. Businesses could not borrow. Families were losing their homes. Investors were desperate for cash. The financial system is often described as the bloodstream of the economy. In 2008, that bloodstream stopped moving. The Federal Reserve responded by cutting interest rates to almost zero. Lower rates were supposed to make borrowing cheaper, encourage investment, and restart economic activity. But traditional interest rate cuts were not enough. Banks still were not lending. Markets remained unstable. The economy continued to contract. The Federal Reserve needed a new weapon. It was called quantitative easing. Quantitative easing, often shortened to QE, sounds complicated. But the basic idea is much simpler. The Federal Reserve creates new digital money. It then uses that money to purchase government bonds, mortgage securities, and other financial assets. Those purchases increase bond prices and push long-term interest rates lower. With safe investments offering smaller returns, investors are encouraged to move their money into stocks, real estate, corporate debt, and other, riskier assets. The goal was to stabilize the banking system, make credit available again, and support the wider economy. At the height of the emergency, it worked. Financial markets recovered. Banks stabilized. Foreclosures slowed. Companies started hiring again. The United States avoided another Great Depression. But there was a problem. The money did not flow through the economy exactly as policymakers expected. The Federal Reserve hoped banks would use the new liquidity to provide affordable loans to families and small businesses. Instead, many financial institutions discovered a faster and more profitable strategy. They used cheap money to buy the same financial assets that the Federal Reserve was supporting. Why make a complicated business loan when you could purchase bonds or stocks that were already being pushed higher by the central bank? Wall Street recovered quickly. The average American did not. By the end of 2009, major banks were profitable again and paying enormous bonuses. Meanwhile, unemployment remained high. Millions of homeowners were underwater. Wages were struggling to recover. The financial system had been rescued, but many people felt that they had been abandoned. The message appeared simple. When Wall Street made dangerous bets, the government protected it. When ordinary families suffered, they were largely left on their own. That resentment would have consequences far beyond economics. Political anger exploded. The Tea Party attacked government spending and financial bailouts. Public trust in institutions declined. Congress became increasingly divided and less capable of passing major economic programs. Infrastructure, education, worker training, and direct public investment required political agreement. Almost free money did not. As Washington became paralyzed, the Federal Reserve became what economists called the only game in town. In 2010, the Federal Reserve launched another round of quantitative easing. This time, it was not simply trying to prevent collapse. It was attempting to generate economic growth. That represented a fundamental change. A small group of unelected central bankers was becoming one of the most powerful forces shaping employment, investment, housing, and financial markets. And once the economy became dependent on their support, removing it would become incredibly difficult. Supporters argued that higher asset prices would create a wealth effect. When people saw the value of their homes, retirement accounts, and investments rise, they would feel wealthier and spend more money. That spending would stimulate businesses and create jobs, but the benefits were uneven. Most financial assets are owned by the wealthiest households. When stocks and real estate rise, people who already own them become significantly richer. Those without homes, stocks, or retirement accounts receive far less benefit. Economist Joseph Stiglitz compared the policy to a form of trickle-down economics. The Federal Reserve could push asset prices higher, but it could not control who owned those assets. Employment eventually improved, but wealth inequality expanded dramatically. For millions of Americans, the economic statistics said the recovery was strong. Their bank accounts told a different story. Low interest rates also transformed investor behavior. Government bonds and savings accounts offered almost no return. To make money, investors needed to take greater risks. Stock prices climbed. Corporate borrowing increased. Real estate became more expensive. The lesson on Wall Street was simple. Do not fight the Federal Reserve. Investors believed the central bank would support markets whenever trouble appeared. But in 2013, Federal Reserve Chairman Ben Bernanke suggested that the central bank might gradually reduce its asset purchases. Markets immediately fell. Bond yields surged. Investors panicked. The event became known as the taper tantrum. It revealed something disturbing. The markets were no longer reacting only to profits, productivity, or economic innovation. They were reacting to the possibility that the Federal Reserve might stop providing easy money. The emergency medicine had become an addiction. For the next several years, the Federal Reserve tried to normalize policy without triggering another panic. Interest rates remained historically low, while the central bank maintained the enormous balance sheet created through quantitative easing. During this period, unemployment declined and the economy continued growing. But beneath the surface, new risks were accumulating. Companies could borrow money at extremely low rates. Instead of using all that money to build factories, create products, or hire workers, many corporations used it to purchase their own shares. Stock buybacks reduce the number of shares available. This often increases the price of the remaining stock and can boost executive compensation. During the easy money decade, American corporations spent trillions of dollars on buybacks. Cheap debt was not always creating productive investment. In many cases, it was being used to manufacture higher stock prices. Private equity firms also took advantage of low borrowing costs. They purchased companies, hospitals, housing, retail chains, and other assets, using enormous amounts of debt. Technology startups received billions of dollars, despite having no clear path to profitability. Companies could lose money for years, as long as investors believed another round of funding would arrive. The financial economy grew faster than the productive economy. More money was being made by purchasing, financing, and reselling existing assets, instead of creating new ones. Then Jerome Powell became chairman of the Federal Reserve. In 2018, Powell attempted to raise rates and reduce the Federal Reserve's balance sheet. Markets dropped sharply. President Donald Trump publicly attacked the Federal Reserve. By 2019, Powell changed direction and began cutting rates again. To many investors, the message was unmistakable. When markets experienced enough pain, the Federal Reserve would retreat. This belief became known as the Federal Reserve put. Investors could take risks, knowing that the central bank might intervene if losses became dangerous enough. When investments succeeded, private investors kept the profits. When the system approached collapse, the public absorbed much of the risk. Economists call this moral hazard. When people believe they will be rescued from the consequences of failure, they are encouraged to behave more recklessly. Debt continued to grow. Risks also migrated from regulated banks into hedge funds, asset managers, private credit firms, and other institutions known collectively as the shadow banking system. These institutions performed bank-like activities without being regulated like traditional banks. By the end of 2019, the financial system looked stable, but stability built on leverage can disappear very quickly. All it requires is a shock. That shock arrived in early 2020. As COVID-19 spread around the world, businesses closed, travel stopped, unemployment exploded, and investors rushed to sell almost everything. Stocks fell, corporate credit froze. Even the market for United States government debt began malfunctioning. Everyone wanted cash at the same time. The weaknesses created during years of easy money were suddenly exposed. The Federal Reserve responded with extraordinary speed. Interest rates returned to almost zero. The Federal Reserve purchased trillions of dollars in government bonds and mortgage securities. It provided emergency funding to foreign central banks, securities dealers, corporations, and shadow banks. For the first time, it even entered parts of the corporate bond market. Everything the Federal Reserve had done during years of the 2008 crisis was repeated in a matter of weeks. And this time, the intervention was even larger. Congress and the White House also acted. The $2.2 trillion CARES Act provided support to businesses, workers, and households. Later programs delivered stimulus checks, expanded unemployment benefits, tax credits, and additional financial assistance. These measures prevented widespread bankruptcies and helped millions of families survive an unprecedented shutdown. But they also poured enormous amounts of money into an economy where production and supply chains remained severely disrupted. Meanwhile, the Federal Reserve continued purchasing approximately $120 billion in assets every month. The emergency fire hose remained open, even after the immediate financial panic had passed. Markets understood the signal. Bad economic news could produce more government support, and more support could push asset prices even higher. Stocks recovered at astonishing speed. Technology companies reached record valuations. Home prices surged. Corporate debt expanded. Cryptocurrencies, meme stocks, special purpose acquisition companies, and NFTs attracted millions of new investors. Social media was filled with stories of instant wealth. The belief that prices would continue rising became more important than the underlying value of the investment. Cheap money encourages experimentation and innovation, but when money becomes almost free, it also encourages gambling. By 2021, speculation was everywhere. Celebrities promoted crypto platforms. New digital tokens appeared almost daily. Companies with weak business models raised billions of dollars. The economy appeared to be booming, but another threat was growing: inflation. Consumers had money to spend, but factories, ports, and supply chains could not meet demand. Too much money was chasing too few goods. Food, energy, vehicles, housing, and everyday necessities became more expensive. Some economists warned that the combination of massive government spending and extremely loose monetary policy was overheating the economy. The Federal Reserve initially described the inflation as transitory. Officials expected supply chains to recover and price pressures to disappear, but inflation continued climbing. Companies reported that their costs were not temporary. Families saw grocery, rent, and fuel expenses consume a growing percentage of their income. The people easy money policies were supposed to help were now being hurt most by rising prices. By late 2021, the Federal Reserve admitted that inflation might not disappear on its own. The word transitory was retired. The age of easy money was about to reverse. The Federal Reserve stopped quantitative easing and began raising interest rates at the fastest pace in decades. The objective was to reduce demand, slow borrowing, and bring inflation back toward the Federal Reserve's 2% target. But interest rates are not a precision instrument. They are a hammer. Higher rates make mortgages, car loans, credit cards, and business financing more expensive. They reduce investment and hiring. In extreme cases, they cause layoffs and recession. The financial system had spent more than a decade adapting to cheap money. Now, it had to adjust rapidly to expensive money. Stocks and bonds fell together. The housing market slowed. Crypto companies collapsed. Highly leveraged businesses faced rising debt payments. As investor Warren Buffett famously observed, you only discover who has been swimming without protection when the tide goes out. And the tide was moving out quickly. Then, Silicon Valley Bank collapsed. The bank had invested heavily in long-term bonds during the low-interest rate era. When rates rose, those bonds lost value. Depositors became concerned and rushed to withdraw their money. The bank could not survive the run. Federal regulators intervened to protect depositors and prevent panic from spreading through the banking system. Once again, the Federal Reserve was forced to manage a crisis connected to the rapid transition away from easy money. The collapse captured the central contradiction of modern monetary policy. Keeping rates too low for too long can create bubbles, debt, and dangerous risk-taking. Raising rates too quickly can expose those vulnerabilities and destabilize the system. The Federal Reserve helped prevent economic catastrophe in 2008 and again in 2020. But monetary policy cannot repair every weakness in society. The Federal Reserve cannot build infrastructure. It cannot reform taxation. It cannot improve education, increase housing supply, retrain workers, or decide how economic growth should be distributed. Those are political decisions. When elected institutions fail to act, society becomes dangerously dependent on central banks to solve problems they were never designed to solve. The era of easy money created growth, jobs, wealth, and financial stability. But it also encouraged debt, speculation, inequality, and dependence. The real lesson is not that the Federal Reserve should never intervene. It is that emergency policies cannot become permanent substitutes for productive investment and effective government, because free money is never truly free. Eventually, the bill comes due. If you want to understand more about how financial crises, inflation, and central bank decisions affect your money, click the video on screen now. Thanks for watching. See you in the next one.